Welcome back to the deep dive. Today, we're tackling something absolutely crucial if you're building wealth.
Or even just trying to keep up.
Exactly. I mean, the whole world of finance changes so fast. We're going to talk about choosing the right broker for what, 2026? It's a different world.
Oh, the game has completely changed. It's not about finding the local branch office anymore. It's about navigating these zero commission apps and AI.
Right.
And if you don't know the right questions to ask, you're really leaving money on the table. Or, worse, you're exposing yourself to risks you don't even see.
I think that's the key. The promise is so tempting, isn't it? A platform with zero commissions, cutting-edge research, a great app, instant service.
Sounds perfect.
But then you look and there are thousands of firms all vying for your attention, all with different features, and it just feels, well, completely paralyzing.
So our mission today is to cut through all of that noise. We want to give you a clear, sort of objective roadmap for finding a partner that's trustworthy, cost-effective, and, rich with features.
And where do we start on that roadmap?
We have to start with the biggest structural change happening right now.
Yeah.
And that's this immediate, powerful push toward near round-the-clock trading.
That is the big story, the one driving all this technological change. We're talking about the exchanges themselves fundamentally changing their schedules.
Yeah, this isn't a small tweak.
No. The New York Stock Exchange is planning to operate for a staggering, 22 hours a day?
22 hours.
Yeah.
And NASDAQ is aiming for a full 24/5 trading schedule. They want that by the second half of 2026.
That's not just an extended lunch break, it's a total paradigm shift.
And that shift means every single brokerage has to evolve, instantly.
Yeah.
We're seeing trading apps scrambling to add things like fractional shares, expanding their robo-advisors.
And the AI-powered research tools.
Exactly. AI tools, social trading communities, all of it built to support this nonstop environment.
It's a ton of information to get your head around, and the stakes are really high. But stick with us. By the end of this deep dive, you'll be armed with what you need to pick your ideal broker.
And just as importantly, how to avoid those costly mistakes.
Okay, so let's unpack this. If the market is running 22 hours a day and the tech is constantly changing, what defines a great broker today?
It's complex. I mean, you have independent reviewers looking at platforms across hundreds of different variables
It's
now.
hundreds. Wow.
Yeah, but it really boils down to three core attributes that consistently separate the leaders from the laggards. The first one, and the one that gets all the attention, is cost.
Right. Everyone advertises zero commissions.
It's just the headline. We have to look at the hidden costs, the real trade-offs involved in that model.
Which brings us to, I think, the most important question for anyone who really follows this stuff. Is a commission-free platform always the best choice? Or is there an invisible fee in there somewhere?
The answer is yes. There's almost always a trade-off. We need to introduce a key term here, something called payment for order flow.
PFOF.
Exactly. PFOF. This is the engine that makes zero commission trading possible. When you place a trade on a free app, that app often sends your order to a big wholesale market maker.
And that market maker pays the broker a tiny fee to execute your trade.
Precisely. So the broker is making money on the volume of trades, not a commission on each one.
Okay, so what's the catch for me, the investor?
The challenge is that the market maker who executes the trade might give you a price that's just a tiny bit less favorable than the absolute best price available in that split second.
That difference is the spread.
That's the spread. And over thousands of trades, that tiny difference in execution quality can add up to some really significant hidden costs, especially if you're an active trader.
So that's the nuance. You have to look past the free marketing and actually check a broker's reported execution quality.
Exactly. So beyond cost, the second attribute is the platform and tools.
How easy is it to use? What kind of research do they have?
Right. Is it their own research or just, aggregated news feeds? And then the product range. Does it just do stocks and ETFs?
Yeah.
Or can you get into IRAs, bonds, futures, Forex?
A full toolkit. And the third attribute.
Service. This is huge. When it's your money, you need someone you can reach. We're moving to a 22, even 24-hour trading day.
So if news breaks at 10 p.m. Eastern and you can't get support,
Then that platform is failing you. Service means 24/7 access, quick responses, and people who actually know what they're talking about.
that service element, it brings us right to that classic dividing line in the industry. Full-service brokers versus the discount online model.
It used to be a very clear distinction.
But it's getting blurry now, right? You have discount brokers adding advisory services.
And full-service firms trying to make their apps better.
Yeah.
But the comparison still matters because it goes right to the cost structure and really the complexity of your own financial life.
So what's the benefit of a full-service broker today?
It's still about that personalized, holistic advice. They help with complex tax planning, estate planning, managing generational wealth. You're paying a high fee for access to a human fiduciary.
Meanwhile, the discount online guys, the zero commission ones, they're all about convenience and much lower costs.
Right. They appeal to the self-directed investor, someone who wants total control and doesn't mind managing their own financial plumbing, so to speak.
So this forces you, the investor, to answer a really fundamental question.
Yeah, which is, how important is that human support to you versus the speed and the latest app features?
So if your finances are pretty straightforward, like just maxing out a Roth IRA each year.
A discount online broker is probably perfect for you. But if you own a business or have complex trusts or you need sophisticated retirement income strategies, then the cost of that full-service advisor might be well worth it.
So the real value of the human advisor is in the complexity they handle, well beyond just placing a trade.
Exactly. It's the strategic oversight that, technology hasn't quite replaced.
Yeah.
Not yet, anyway.
Okay, speaking of strategy, we have to cover the most non-negotiable step of all, ensuring safety and legitimacy before you put a single dollar anywhere.
Absolutely. So many people skip this. They see a flashy website and just assume the firm is legit.
But they often aren't.
Not always, no.
Yeah.
The critical safety tool, here in the U.S. at least, is FinRA's Broker Check.
And that's a free resource for anyone to use. What does it actually tell you?
It lets you check if a broker or even the individual advisor you're talking to is properly registered and licensed. But crucially, you can see their professional background and, most importantly, their disciplinary history.
So you can see if they've faced regulatory action or if clients have sued them for, I don't know, unauthorized trading.
All of it. Broker Check is designed to protect you by making that history totally transparent.
That's mandatory due diligence then. If you find a firm on social media promising huge gains, but you can't find them on BrokerCheck, or you see a long history of complaints.
You walk away immediately. It doesn't matter how low their commissions are.
We really can't overstate this. Before opening any account, you have to perform these checks. Use BrokerCheck or your local securities regulator. It is the absolute bedrock of investor protection.
So once you've done that, now we get to the really interesting part.
Matching the platform to your style. Because the best broker for someone putting $50 a month into fractional shares is totally different from the broker for a pro options trader.
Oh, completely different. Suitability varies so much. You see firms that specialize in active trading, focusing on high-speed execution, advanced order types.
While others are all about long-term investing, so they'll push low-cost index funds and retirement planning tools.
Right, and then you have specialists for global markets access, or even firms dedicated entirely to socially responsible portfolios.
And when you look at the recent industry reviews, for just overall quality and being friendly to beginners, you see the same three names over and over.
You do.
Fidelity, Charles Schwab, and Interactive Brokers. But what's the real difference between them in practical terms?
Well, they really represent different parts of the market. Fidelity and Schwab are just exceptional for the long-term investor and the beginner.
Why is that?
They offer unbeatable educational resources, a massive range of products, great branch support in Schwab's case, and a platform that's really designed to grow with you. They're these safe, comprehensive giants.
Okay, so where does Interactive Brokers fit in?
IBKR, or Interactive Brokers, is it's typically the choice for the experienced trader, the institutional client, anyone who needs global access and a lot of complexity.
Lower costs for active trading, you said?
Some of the lowest margin rates,
Yeah.
and the best access to complex things like futures and global forex. The platform is incredibly powerful, but it's a bit less user-friendly for a novice.
So if you're a beginner, you're probably looking at Fidelity or Schwab. If you're a pro who needs cheap, fast access to derivatives in 5 different markets, you're looking at IBKR.
That's the key distinction. And it also answers that forward-looking question about whether a broker can grow with you. A place like Schwab or Fidelity can. They start simple, but they have the full suite of services you'll need when your portfolio grows.
They can scale from a simple account right up to a family office.
Exactly.
So let's circle back to the biggest trend for 2026, these extended trading hours. The 22-hour and 24/5 schedules. We know it offers opportunity, right? You can react to news out of Asia or Europe instantly.
For sure.
But what does it mean for the risks facing the average investor?
The big risk, it all comes down to one word: liquidity. The crucial question is, how will these extended hours affect liquidity and risk? Historically, after the main session closes, liquidity just dries up,
Fewer buyers and sellers.
way fewer. And that means the spread, the gap between the buy and sell price, it widens, sometimes dramatically.
And I can see how that's a problem. If I put a stop-loss order in overnight when liquidity is thin, a single small trade could trigger it at a terrible price.
That's exactly right. That's called slippage. The potential for that kind of volatility, for wide spreads, it just increases significantly in those off hours. So while 24 by 5 trading offers convenience, you have to be so aware that market conditions can be thinner and much less predictable.
So the technology isn't just for convenience anymore. It's almost necessary for survival in this new market.
Absolutely. This whole 24-hour structure, it relies completely on things like enhanced robo-advisors that can make adjustments while you sleep, or AI that can flag global opportunities in real time. The technology is what tries to mitigate the risk that's inherent in continuous trading.
This has been an incredibly deep dive. Let's try to give a quick, actionable summary for everyone listening. First, look beyond the zero commission sticker price.
Right. Understand the trade-offs, especially PFOF and execution quality.
Second, make a conscious choice about service. Do you need a human advisor for complex life stuff, or is the convenience of a digital platform enough for you?
Both are valid. They just serve different needs.
Third, and this is the big one, non-negotiable, use fine or a broker check. Verify the legitimacy and the history of any firm you're considering. It's your shield.
And finally, suitability is everything. Match the broker to your goals. Fidelity and Schwab are fantastic for beginners and long-term growth. Interactive Brokers is built for complexity.
And if we just connect this to the bigger picture, it all comes down to critical thinking. It's so essential in a world where the marketing is all about the excitement of 24-hour trading and not so much about stability, execution, and service.
A phenomenal thought to end on.
But here's something for you to mull over as you research your next broker. Given that the entire market is moving toward this near round-the-clock schedule, what unexpected demands is this shift going to place on customer support and technology? Just to ensure stability. If the market never sleeps, who's answering the phone at 3 a.m. when the AI fails?
The answer to that question will define the true leaders of 2026.
We'll catch you on the next deep dive.